Okay, folks, we'll get started. It's my pleasure to welcome Jack Manley and his team from JP Morgan Asset Management. Um, I'm not going to read his bio. Jack, he's a celebrity. You guys have probably seen him on BNN, CNBC, Bloomberg. Geez, what have you not been on? You publish a lot of stuff as well,
Yeah.
right?
Yeah.
I saw you on BNN the last session you were on, and so I was like, oh, I hope he doesn't repeat that in his presentation. That's all I was thinking. No, we're lucky to have you. Thank you so much for being here. What I thought was interesting, just quickly, University of Chicago.
That's right.
History.
Yeah.
Can you say something about that?
People ask me that. Yeah, I always figured in school that I would have very few opportunities to learn about stuff like that kind of in the future in my professional career. I knew I wanted to end up in finance. I didn't know I wanted to do this exactly, but I knew I wanted to end up in finance, and I figured I'd have my whole career to learn about economics and learn about markets. And so I went to liberal arts route.
Oh, wow.
I'm
That's
happy.
awesome.
Yeah.
I love it. That's great. I love that background. I always thought that, I mean, even as an economist, right? Investments is a little bit of a weird, it was a perfect fit. But I find that I actually use more of my counselor hat, my bartender hat, my couples therapy hat than I do my economist hat or anything that I learned at university. So again, thanks again for being here. I'll kick it off to you and I'll let you run the show. Thank you.
Well, that sounds
Everyone,
good.
welcome Jack Manley.
Oh, thank you. Great. Well, good morning, everybody. Thank you very much for the invitation. Very nice to be here. There's a lot of stuff, of course, that we have to cover, a lot of ground that we got to get through. There's a lot of news out there. There's a lot of information swirling around. And oftentimes it can be quite difficult to kind of isolate the signal from all the noise that is out there on the investing landscape. I think that ultimately the end goal of any sort of presentation like this is to land on the investment implications, right? To talk about how to position yourselves in your portfolios across stocks and bonds. But if you want to get to that point, there are a couple of steps that you need to take first. The first one being that you have to understand, I think, what's going on with interest rates. You look at what happened to capital markets around the world in 2022, very clearly reacting to ultra aggressive monetary policy tightening. 2023, very much the same story for most of last year, interest rates moving higher and markets struggling, particularly on the bond side, until closing the gap towards the end of last year. I would assume that this year is going to be a pretty similar story, where interest rates drive the overwhelming amount of returns, and then next year will probably be pretty similar. So having that view on interest rates is, I think, instrumental for having that view on investing. But to have that view on interest rates, you have to have a view on the economy. Central banks around the world hold press conferences, they issue statements, they raise or lower rates, they manipulate their balance sheets. They don't do it to annoy us or confuse us. I know it sometimes can feel like that. They don't do it to hurt or help their respective equity markets. They do it because they have economic mandates, right? They're looking at things like employment, inflation, GDP growth. So to have that view on interest rates, which again is, I think, instrumental for having that view on investing, you have to have a view on the macro. So that to me is foundational for this conversation. It's always where I like to start these things. And you can interpret that as sort of a loose agenda for what I'll be talking about over the next 30 minutes or so. That backdrop, talking about how that translates into interest rates, and then landing on those investment implications. And to do that, we'll be going through a handful of slides from JP Morgan Asset Management's flagship publication called The Guide to the Markets. The guide is a collection of about 68 pages of charts and graphs organized into different sections, looking at things like the economy, the stock market, the bond market, interest rates, alternatives, even some high-level kind of evergreen investing principles. I'm very proud to say that the guide is now in its 20th year of publication, meaning this was one of the first of its kind to market. And to date, it is consumed by 400,000 financial professionals every single quarter, making it sort of the gold standard for this material. I'll be introducing you to a few of the slides from the Guide to the Markets to help to tell this story that I'd like to tell over the next half hour. Now, with that, let's start by talking about the state of the U.S. economy, right? And I think that starting with the U.S. economy is extremely important. And it's important for a couple of reasons. One of them, as you may have heard before, is that when the U.S. sneezes, the rest of the world typically catches a cold. And that is true nowhere more than it is true here in Canada. Our economic linkages are enormous. The populations of our economy, the betas of our economy, what happens in the States matters a lot for the rest of the world and matters for Canada in particular. But even more than that, I think the reason it's important to talk about the US economy is that last year, global GDP was almost overwhelmingly a disappointment. So many countries and regions failing to live up to expectations. Europe failed to live up to expectations. China generally failed to live up to expectations. Canada too have failed to live up to expectations. But the US beat those expectations. A year ago, if we were having this conversation, other strategists, people in my shoes, would have been calling for a recession in the US economy in the back half of 2023. The Federal Reserve cutting interest rates, the equity market flat or down. But not only did this economy manage to defy expectations and avoid a recession last year, it actually managed to defy gravity. In third quarter, GDP came in at 4.9%. Fourth quarter in at 3.3%, more than double what we're expecting out of Canada over the same time period. This is an economy that has been remarkably resilient. And there are a lot of problems with the US economy, problems that are problems in a lot of other economies. I mean, certainly there's headline risk out there, right? Those things that kind of beat down on our confidence. You have war in Europe, you have war in the Middle East, you got tensions with China that continuously seem to simmer. And in the States, a pretty significant presidential election coming up before the year is up. And then even outside of those confidence busters, you have structural drags on economic output. Now, if you look at the right-hand side of this page from our guide, we break out US GDP into its various subcomponents. And you can really point to any one of these things and identify a pain point. Net exports on the bottom in purple, that's going to be the trade deficit. The US, like Canada, is generally speaking a net importer. That's the nature of our economies. But the US dollar has been singularly strong over the last 2 years. Extraordinarily strong. Great news for me as an American going abroad. Bad news for the US economy, because a very strong dollar makes American exports that much less competitive on the global marketplace. It makes foreign imports that much more competitive on the global marketplace. Net exports dragging unusually on economic output. The housing market is up top in dark green. Again, a similar story to what we have happening here in Canada. Mortgage rates are up and home affordability is down. And if we're not buying as many homes as we used to because we can't afford to buy those homes, and the builders just aren't building like they probably should be. Home building activity is usually about 5% of economic activity in the States, about 10% of economic activity in Canada, dragging on both of our respective economies as a result of the interest rate environment. And then, of course, you can point to government spending, where the states are not spending like they did in the immediate aftermath of COVID, or investment spending right out of businesses, feeling the crunch from that regional banking crisis that we saw in the first half of last year, right? A lot of different structural anchors dragging on economic activity, compounded by those confidence busters. So the US economy managed to emerge last year as one of the only big winners in terms of growth. Well, it's because there is this one very clear bright spot out there on the economic horizon, and that has been the labor market. Just an extraordinarily tight labor market in the United States. The unemployment rate sitting at 3.7%. And with the most recent blockbuster employment report, we have now had that unemployment rate at or below 4% for 26 consecutive months. We have not seen an uninterrupted period of strength like that in the labor market since the 1960s. Every month, our economy adds 100 or 200 or most recently 300,000 jobs. There's a lot of strength in this labor market, and that strength comes because of a very basic supply-demand imbalance. There is too much demand for labor, too many job openings out there, and simply not enough bodies to fill those seats. And that's largely a demographic problem. The American population is aging. Our birth rate is declining. Legal immigration is lower. And then COVID complicates this story by pushing about 2 million individuals prematurely into retirement. That's a lot of people that have left. It's a big gap to fill, and it's not something that can be plugged overnight. And yes, there are a lot of issues out there. The confidence isn't so good. The structural anchors are quite relevant, but 70% of US GDP comes from consumption. And if the consumer is still employed, then they're still collecting a paycheck. And that paycheck allows them, empowers them to continue to spend. And that's why this engine of growth just kept on turning despite all these other issues that we've been dealing with for the last couple of years. And given the fact that this labor market seems to be structurally tight, unusually tight, and I don't expect a massive surge in unemployment this year, I don't think this narrative is going to change a whole lot. My base case for 2024 is maybe a slowdown in economic activity off of some red hot prints in the back half of last year, but no recession in sight, which is good news for those global investors that recognize that most economies are linked to the health of the US economy. But I could be wrong. There were, again, people in my shoes a year ago that were staking their reputations on this idea that the US would be in a recession at this point. They couldn't have been more wrong. I am not going to stake my reputation and say that certainly we will avoid a recession this year. Maybe we get hit by some truck that we're not looking at. That's usually the way this stuff works. And I think that when your clients are reaching out to you and asking you about recession risk, worried because they're watching too much TV or reading too many headlines, they're not actually asking for a yes or no answer to that question. They're curious about the implications. Are they going to lose their homes, their cars, their jobs, their retirement savings? How bad is this thing going to be? And that is a very fair question to ask, because the last two recessions that we experienced were the worst two recessions that have been experienced in a century, between the financial crisis and COVID. So now investors are terrified of what a recession actually means. And so I think it is a helpful exercise to kind of play devil's advocate here. Acknowledge that I don't have a crystal ball, say that maybe I'm wrong about this economic outlook, and then try to figure out how bad things may get. And that's why I like page 18 from our Guide to the Markets, the cyclical sectors page. It looks at the four most volatile, most cyclical parts of the US economy. So you have residential and business investment up top, vehicle sales and inventory numbers on the bottom, slice it a different way, the consumer on the left-hand side, corporate on the right-hand side. I like to call these the usual suspects. And the reason for that is that on some of these charts, we show upwards of 60 years of economic data. There's a lot of information on this page. And we chart recessions as thin gray vertical lines. And look at those recessions throughout history, because preceding almost every single one of them is a spike in activity across one or more of these sectors. Areas of excess, of overextension, of imbalance. These are macroeconomic bubbles. Think about what the housing market looked like in 2007, before the subprime crisis imploded. Right, the problem is that the nature of a bubble is to burst. That's what bubbles do. And when the bubble bursts, the pendulum swings in the other direction. You go from boom to bust, and you get that big, deep, painful recession. So hard to claw yourself out of. But if you look at where we stand right now, that is not the story that's being told. None of these sectors are jumping off the page, screaming excess or overextension. There are no obvious macroeconomic bubbles to speak of. And while that does not mean that we can't get a recession this year, plenty of things wrong with this economy, just as they were wrong last year and the year before. It does suggest that if a recession were to materialize, it's not going to feel like 2008. It's not going to feel like 2020. It's going to be more short, shallow, mild, mellow, kind of technical in nature. The lack of any sort of meaningful imbalance in this economy may be boring, but it is dependable. Now, the other big macro force that, of course, we need to discuss here is inflation. And I think it's always nice to talk about US inflation up here in Canada, because this is one example of something where you can look at our data almost as a crystal ball for what's coming down the line for you. And the reason for that is very, very simple. And it has everything to do with COVID. The pandemic hits in March of 2020. The whole world shuts down for the most part. But different countries emerge from the pandemic in different stages. I live in New York City. We were pretty serious about COVID for a while, maybe about a year. And then by 2021, most people who wanted a vaccine had gotten one. The mask mandates are gone. The social distancing is done. And yeah, maybe we're not traveling as much, but the world is more or less back to normal. I spent a lot of time down in South Carolina during COVID. And down in South Carolina, COVID never existed. Nothing ever closed. No social distancing. No mask mandates. But meanwhile, I was out in Montreal talking to clients in 2022, and mask mandates were still being enforced at the little restaurant that I had dinner at. Our economy, the US economy, has been growing post-COVID for 3.5 years. The Canadian economy is in a much earlier portion of its cycle. And so you can look at what's been going on with some of these key US economic indicators and kind of get a sense of what will come down the line in Canada. And inflation is a great example of that because in both Canada and the United States, very clear disinflationary trends have emerged. Disinflation meaning not deflation, right? Prices aren't going lower, I wish. They're still going higher, they're just going higher at a slower rate. And nothing shows this better than the chart on the left-hand side of this page from our guide. In June of 2022, headline CPI in the United States came in at an eye-watering 9.1%. That is the strongest inflation read that we had seen in 40 years. And then 12 months later, in June of 2023, that number got all the way down to 3.0, a very different inflationary environment. And since then, things kind of bounced around a little bit. If you're trying to figure out where inflation is going to go from here, it is important to understand how inflationary forces have shifted over this time period, what caused that precipitous decline in CPI. And a lot of it just has to do with the state of the world in these different time periods. You rewind the clock a little bit to June of 2022, the world's a different place. Russia had invaded Ukraine only a few months earlier. And both of those countries, very large producers and exporters of commodity products, food and fuel. We don't know how we're going to get a hold of this stuff anymore. We don't know how bad the winter is going to be in Europe and how much demand there will be for these products that are now going to be a whole lot harder to come by. And at the same time, China is still locked down with zero COVID, while the rest of the world moves on to normalize living with the virus. China tries to stamp it out. Manufacturing output is hampered, and any sort of finished good that you're trying to get your hands on that happens to make its way through a Chinese plant becomes a lot harder to come by. You're dealing with scarcity in 2022. And you can see in that 9.1% headline CPI print, if you were to remove energy, food, and vehicles, which we treat as a proxy for finished goods, that number gets cut by more than a half. And so what happened over the subsequent 12 months is that this stuff just got better. That's what happens with supply chains. Things get rerouted. China opens up. Energy goes from being inflationary to deflationary. Vehicles from inflationary to deflationary. This has nothing to do with monetary policy. This is just the normalization of supply chains, which means, unfortunately, that was the easy part. The path forward is a lot more complicated because things driving inflation today are much stickier than what was driving inflation back in 2022. Look again on the left-hand side of the most recent headline CPI, 3.4%, and you'll notice that 2/3 of that are coming from one bucket, shelter. Same thing is happening here in Canada. Shelter is the overwhelming driver of today's inflation. And the funny thing about shelter is that at least when it comes to CPI, it is not a function of home prices. It is instead a function of rent. And isn't it funny that as central banks have raised interest rates to try to stamp down prices, they have decreased the affordability of home ownership and pushed would-be homeowners into the rental market. As I said earlier, I live in New York City. I cannot afford to own a home. So I rent. My rent today is a whole lot more expensive than it was a year ago. It's more expensive than it was the year before that. Rental inflation is a direct result of interest rate policy. And while we have seen very clear graphical evidence that those bars are getting smaller every single month, it's going to take a significant change in monetary policy to push those down a whole lot more. So I do think inflation will likely hit 2%. I don't think it's necessarily going to happen this year. And I think in the path between now and there is going to be a bumpy and quite uncertain one, with the last 6 or 7 months of data being evidence of exactly that. So a view on growth, a view on inflation, I think the next natural question is, well, what does all this mean for interest rate policy? And that's where there are a whole lot of opinions. Right, the nice thing here is that we are no longer talking about when central banks are going to stop raising rates, at least not in this part of the world. Bank of Canada, the Federal Reserve have both been pretty darn clear in their most recent press conferences and statements that this rate hiking campaign is over. The question now is about when they're going to start to cut and by how much they'll cut once they start. And I think if you're trying to figure that out, well, you have to assess how badly our respective economies need interest rates to come off the boil. And for better or for worse, I think the Canadians need it a lot more than the Americans. And the reason for that is very simple, which is the nature of your mortgage markets. In the States, 90% of our mortgages are 30-year fixed rate, which means, yeah, mortgage rates are higher for new home buyers today. But if you bought your home 2 years ago, 3 years ago, 5 years ago, 7 years ago, your payments have not changed. Your ability to consume has been maintained. Another reason why the economy has done so well. Here, the mortgage market doesn't work the same way. You are forced to refinance that much more frequently. These higher rates are flowing through into your ability to consume that much sooner. And so I think that the Bank of Canada is going to capitulate and will likely start to cut as soon as the second quarter of this year. Not by a lot, but begin the cycle. In the US, it's a different story. One of the cool things about the Federal Reserve is that they do this thing that almost no other central bank on earth does, which is that they publish something called the Summary of Economic Projections. Summary of Economic Projections basically being the Fed's way of telling us what they think is going to happen with inflation, employment, GDP, and interest rates. Put it out on a quarterly basis. The most recent publication was just about a month and a half ago in December. And we show what the Fed has told us on the right-hand side of this page. It's that blue line where the Fed has told participants to expect 75 basis points of cuts this year. But we also show in green what the futures market's looking for. And you will see that these lines do not line up. Futures market's not buying what the Fed is selling and thinks the Fed will be more aggressive this year, cutting not by 75 basis points, but by 100 or 125, or not too long ago, upwards of 150. So who's right? I mean, that is like the trillion-dollar question that we're trying to answer right now. And there are a couple of things that I think are worth pointing out here. The first one being that the futures market does not have a great track record when it comes to calling what's going on with interest rates. In fact, the futures market has been wrong about what the Fed's going to do every single step along the way since this hiking cycle started 2 years ago. So I don't think they have a ton of credibility. And perhaps more to the point, I don't think the Fed has done a particularly good job of managing monetary policy over the last couple of years. But one thing you have to give to them is that they've been pretty honest about their intentions. And they have not really ever failed to deliver exactly what they told us they were going to do. I don't control monetary policy. I don't sit on the FOMC. Nobody calls me and asks me for my opinion before they make a decision on raising or lowering rates. I cannot pretend to know better than the Fed. But I think the most important thing to point out here, right, is that if the futures market is correct and the Fed doesn't cut by 75 basis points, but instead by 100 or 125 or 150, it's because something really wrong has happened in the US economy. And nobody wants to root for that. It means that the Fed feels compelled to abandon the playbook that it laid out just a month and a half ago, deploy emergency measures to stimulate the economy. And given the fact that a recession seems out of the question in 2024, that the unemployment rate should stay structurally tight, and that inflation is going to take some more time to cool all the way down to 2%, I don't think the macro data support that outlook. So I am more in the camp of the Fed. 75 basis points this year, likely starting in the back half of 2024. But in some ways, right, a lot of this is just noise. Because we're all in agreement about one thing, which is the direction that rates are going this year, and that is lower. And so I think that is enough for us to move on to this sort of final portion of the talk, which is to say, what does all this mean for investing? And I'd like to start by talking about fixed income because I think that bonds have a bad reputation. A lot of investors wonder why they own fixed income, and you cannot fault them for that skepticism. What did fixed income do for you in 2022? Nothing. What did it do for you in 2023? Basically nothing, up until the very, very end of the year when we saw a whipsaw on rates because of a pretty dovish Federal Reserve announcement. People are scratching their heads and wondering, what is the utility of this instrument? Why do I buy a bond? It's because they think it's broken. Fixed income delivers two things to us. That's why we own it. The first one is income. It's right there in the name, right? And then the second one is protection. The income component is easy. It's straightforward. You can find coupon with your eyes closed. Look at what's going on in money market funds and other cash accounts. You don't have to take any risk whatsoever. Clip a bigger coupon than you have in 20 years. But it is the protection component that gets a little bit muddy. And that's where things are misunderstood because so many investors have conditioned themselves to think of fixed income as providing them protection against the equity market. Clearly, it was not the case in 2022. Because maybe what fixed income actually does is provide protection against the economy. In the sense that if my macro outlook is wrong and the US economy enters a recession and the Canadian economy follows us in, the first thing that our respective central banks are going to do is cut interest rates and cut them aggressively to stimulate growth. And when rates are falling, the value of any existing fixed income instrument that you own goes up and you make money in bonds. And nothing does a better job of illustrating that, I don't think, than the right-hand side of this page from the Guide to the Markets, which looks at the impact of a 1% rise or fall in interest rates on the total return of all these different pockets of the fixed income market. Blue is what happens if rates are falling, gray if rates are rising, and you don't even have to read the numbers. All you have to see is that the blue bars are bigger than the gray ones. A really nice, clean visual making the point that there is more upside potential in fixed income markets today than downside risk because of this coupon cushion that we have built up over a couple of years of pain, allowing us to weather interest rate volatility, at least in the short term. No, I think coupon will likely do the majority of heavy lifting in fixed income this year because of that rally we saw in the last couple months of 2023. But if I'm wrong about that outlook, and the Fed doesn't cut by 75 bips and instead cut by 100 or 125 or 150, the yield curve will react and the protection will kick in. It's an exciting time to be a fixed income investor. Now, on the equity side of things, we have to divide things up between what's going on in the United States and what's going on around the rest of the world, because sort of like with the US economy, the US equity market marched to the beat of its own drum last year. No one thought we were going to see even double-digit returns. And here we are with an equity market that over the last 13 months is up around 30%. But the way we got there doesn't feel great. This was not a broad-based recovery. But it was a very narrow recovery. It was a small handful of names that did the heavy lifting. I'm sure you've all heard about the Magnificent Seven, right? Those large, growthy, high-flying technology names based in the United States that benefited from this assumed collapse in interest rates this year. And of course, the artificial intelligence craze that kind of swept through markets a little after this time last year. In fact, if you look at the chart on the left-hand side of this page, you will see that the 10 largest names in the S&P 500 accounted for almost 90% of all those returns we've seen over the last 13 months. That is extraordinary. And if you look at the right-hand side, we can try to figure out how we got there. On the top portion of that side, you'll see that the 10 largest names in the index are as large as they have ever been in history, with just those 10 names accounting for a third of overall index market capitalization. That's index concentration. And yet, despite being a third of index market cap, as we show on the bottom, they only contribute a fifth of index earnings, which means there is a disconnect that has emerged between prices and earnings, resulting in inflated valuations, meaning that this equity market recovery has not only been driven by a very small handful of names, but those small handful of names have taken off to new highs based almost entirely on multiple expansion. So how do you stay constructive on US equities given that backdrop? And when the bond market looks better than it has in 20 years? It's hard. But what you have to do is remember that there are another 490 plus names out there in the index that haven't done a whole lot of anything over the last 13 months, that are trading at much more reasonable valuations. And hey, if the math shakes out on the right-hand side, they're actually punching above their weight class from an earnings contribution perspective. So many investors today want to try to frame up the investing conversation in terms of those Morningstar style boxes. They're good, they're handy, they're helpful. But this is not a conversation of growth or value. It's a little bit of both. The real emphasis needs to be overwhelmingly on quality as your factor of choice, meaning dependable earnings growth, strong balance sheets, reasonable valuations, and that emphasis on quality coming from this idea that, hey, money is not free anymore. So you got to be thoughtful about how you allocate. And when you allocate, understanding that these dislocations are profound. It's not about style boxes or even sectors. It's about individual securities. This is an environment for active management. And that's how you stay excited about an otherwise challenged asset class. Now, what I'd like to do is leave you on this page and then open things up for questions. Looking at 15 years of asset class returns on what we like to call the quilt chart. I just spent the last half hour or so going over some high-level views for what may happen with growth, inflation, employment, interest rates, where the risks and opportunities may lie in stock and bond markets, but ultimately, I don't have a clue. I don't know. I don't have a crystal ball. I could be completely wrong about all these things. Everything I just told you is a guess. I think they're good guesses. I think they're guesses that are backed up by a lot of research. I know they're guesses that are backed up by a lot of research. I think they're guesses that are backed up by very attractive charts as well. But they're guesses at the end of the day. You look at this page and you will see that in any given year, it is impossible to predict the winners and the losers. Because in any given year, it is impossible to predict that next big source of volatility, up or down. 4 years ago, no one is pricing in a global pandemic. 3 years ago, no one is pricing in a war in Europe. A year ago, no one's talking about a war in the Middle East or even at that time, artificial intelligence. Who knows what is coming down the pipeline in 2024? So instead of trying to predict that next big source of volatility, you got to do the next best thing, and that is prepare for it. And you do that through diversification. Owning a little bit of all this stuff that I just talked about and more, and putting together a nice asset allocation portfolio. And the unfortunate reality is that in today's world, with so much instant gratification at our fingertips, asset allocation has kind of fallen out of favor. It's not in vogue anymore because it's never at the top of the pile. So many investors want to know why they should own bonds when they can just own stocks. Why own value when they can just go all in on technology? Why bother with anything outside of the United States? And we can talk about some of those opportunities if you're interested. But at the end of the day, we are not day traders. At least I don't think so. We're not out there chasing performance. We are long-term investors looking for long-term investing success. And if that is the mindset, then we have to remind ourselves every once in a while that the journey is often just as important as the destination, and that diversification is what's going to get you there safely. I'd like to thank you all very much for the time. It's a pleasure being here.
Thank you so much, Jack. That was awesome. This is, yeah, you can take your phones out. You can take a picture of that, or download the link there. I'm gonna have a copy of these presentations made available to you guys as well. In terms of CE credits, you guys make sure you email me, myself, Trevor, and Declan. If one of the three of us gets your CIPR number, we can get you the CE credits. So make sure you do that, and then I'll also make sure you get the link for these presentations. Jack, one of the questions I know there's probably a lot of questions, but I kind of want to selfishly start it off.
Yeah.
And it just has to do with, like, in terms of other factors other than the market, like specifically I'm thinking about ESG.
Mm-hmm.
How much of that has impacted company returns, company performance, and then as a result, portfolio construction?
So the ESG conversation in particular it's an interesting one because it's difficult, because ESG I think has a real branding problem, where it has become synonymous in certain parts of the world with, lunacy, and in certain parts of the world as being gospel. And I'm sure it's the same here as it is back in the States, where if I go down to Houston, nobody wants to hear about ESG. But if I go out to San Francisco, everybody wants to hear about ESG. I'm sure it's the same stuff out here, right? Everybody has those different opinions. It's a branding problem. And so when I think about ESG kind of looking into the future, what I want to do is sort of reframe the narrative and talk about it in terms of long-term, unavoidable trends, things that everybody can kind of get their hands on. So let's talk about G as an example, right? Well, sure, who wouldn't want to invest in a well-governed company? But what is an actual tangible example of corporate governance that is important? It's cybersecurity. You think about what's been going on over the last 5 to 10 years, you see all these foreign powers starting to act in hostile ways against countries like the United States, like Canada, hacking into our institutions, financial, government, whatever it may be, stealing our information, compromising our identities. JP Morgan actually has this, or they used to in our old building, they had this insane display in the lobby behind their security desk, where they would have lights pop up every time our server got pinged by somebody trying to get in. And it was something like 6 or 8 billion attempts every single day, and that's one company. The cost of cybersecurity failures is enormous. There's monetary incentives, right? Because you got to pay out to people that have had their information stolen. There's reputational risk because now people don't want to do business with you. So investing in cybersecurity is an excellent example of what good G looks like in ESG. And then on the environmental side of things, it's another one that I think is worth pointing out. You don't have to have an opinion on climate change or global warming or whether fossil fuels are morally good or morally bad. All you have to do is recognize that one of life's few guarantees is that we are going to run out of fossil fuels at some point. But when we do, we're not going to stop needing energy. And so I almost think of the E component of ESG, the transition to renewable resources, is not like a morality play, which it oftentimes is framed at, which really pushes a lot of people away. They don't want to be told that they're bad people. And instead is almost a ground floor investment in infrastructure that has the potential over not the next year, but over the next 10, 20, 30 years to totally transform the energy landscape. And you're already starting to see that happen in Europe, where they don't sit on as much natural resources as you would find here in Canada or down in the States. So ESG is about reframing that narrative to be less about like being a do-gooder and more about those long-term trends. And I think you are starting to see that shape out. And I think that narrative continues to evolve.
Well, when I think about JP Morgan, I think about ESG, I think about how active you guys are in terms of voting shareholders or unit holder proxies when it comes to ESG considerations at the board level. Can you give us an example of a case or story that was interesting?
I truly wish I could, and I cannot. I have no insight whatsoever into those how those votes were made. Sorry.
Any other questions?
Sure. And then. Yeah.
And inflation on those top 10. Oh, sorry.
I gotcha.
How did that happen? So we have this massive inflation of the top 10 stocks in the S&P, and then on the other side, your earnings. How does that not spell a crash coming when the price that I'm putting a valuation on my company based on my earnings is not the same as the 2008 market crash when the housing market was exactly the same thing? How are we not in for a crash at that point?
So two things I'd say to that question about being concerned about where valuations are given this run up in the largest names. The first one is that there could be some pain felt in those biggest names as they kind of return down to earth, at least temporarily. And that is why security selection is so important right now. And in fact, I've heard other people at JP Morgan talk about going as far as, long short funds, which is not always an option, right? But that is some way to sort of exploit some of these dislocations in the market. So I think that does support this narrative for a broadening out of the recovery, for looking beyond the top 10, for finding those individual names that are going to do well, regardless of the broader kind of slowdown in economic activity and elevated valuations. But the other thing that's worth pointing out is that we are not in another dot-com bubble, because the names right now that are the biggest and most profitable are real companies that make real things. Right? Like no one is going to look at Microsoft and tell you that it's the same thing as pets.com. It is a completely different animal. And in some ways, I mean, now we're getting kind of like theoretical here, but in some ways, I think that you can make the argument that next 12-month valuations don't actually matter a lot for a market like the United States, because the US market is now about 30 to 40% technology and tech adjacent. So remember, Amazon's not a tech company, it's a consumer discretionary name. Tesla is not a tech company. Netflix is not a tech company. Examples like that. Disney's not a tech company. You have a lot of technology in the index, and technology is inherently a longer duration asset. It is very, very sensitive to interest rates because you don't buy these names for what they're going to do for you over the next 6 to 12 months. You buy them for what they're going to do for you over the next 5, 10, 15 years. So another part of this narrative is that, yeah, maybe in the short run, these big names lose a little bit of steam and some of the other names start to play catch up, and you can have that almost tactical allocation in 2024. But I would never advocate dumping the winners of last year, those Magnificent Seven, because they actually are real companies with real earnings, impressive stories, and long-term growth trajectories. So it's just about finding how to make sense of markets in this year. And then I think one more question. Yes, from you.
Well, it kind of touched on it a little bit there, but you mentioned, strong labor market, but
Yep.
we're starting to see a lot of layoffs in tech and communications and stuff like that. Is that layoffs going to continue, or is that just the glut from the hiring from the COVID, the boost in technology?
Yeah.
And are we going to see that affect, and again, you talk about Amazon and
Yeah.
Disney and, Microsoft, which are laying off and,
So if I had to guess, I would say it is more symptomatic on hiring glut that they eventually have to sort of work their way out of, over expanding during COVID. And you start to see that happen last year and even the year before, some high profile layoffs. But what I think is very important, and this is like sort of a silly thing to say, but I think it's important to say it anyway, is that it is hard to imagine just how big the US labor market is. Like you're talking about 150 to 200 million people that are working. You see a headline comes out that says that Amazon fires 15,000 people. That is a rounding error on that number. It doesn't move the needle at all. And just like up in Canada, the overwhelming driver of employment in our countries is small businesses. The Fortune 500 contribute a lot. I mean, JP Morgan alone employs probably 100,000 people in the United States. Amazon's probably something pretty similar to that. But 100,000 people is less than 1% of the overall labor force. So you may continue to see some of these like tech layoffs roll through. And I think one of the things that we've seen happen in general over the last few years is what we call almost a rolling recession, where different sectors go through periods of slowdown and different sectors go through periods of growth. You know, mortgage servicing did not do particularly well a couple of years ago for probably pretty obvious reasons. Now technology is going through something kind of similar, but I don't think it is symptomatic of broader problems with the labor force. And just like last year, how it didn't really make a difference, I don't think it's going to make much of a difference this year either. No, that's the short answer. No, I think that and this is, unfortunately, this does have to be the last question. I think what you're going to see is us moving away from a unipolar world to a bipolar world, where certain countries choose to do business in, generally speaking, going to be the yuan, transacting in the yuan as opposed to transacting in the dollar. I don't think India is at risk of doing that just yet. I think they want Western investment, and they're not going to get a whole lot of that. They play too nice with China and Russia, but I think China and Russia will continue to operate together. I think that Brazil will likely be tossed into that mix, and then you're talking about other, economic powerhouses like Venezuela and Cuba that are joining, the ranks over there. Maybe some countries in the Middle East or Africa. We are entering this bipolar world, but I don't expect it to change anything from a trade balance perspective, from a dollar dominance perspective, because there's no way that the Americans are ever going to do business in the yuan, and you guys are never going to do business in the yuan, and the UK won't, and Japan certainly won't, and Europe almost certainly will not. So yeah, you get this bifurcation in currency regimes, you get this bifurcation in kind of trade agreements. It almost feels like a Cold War, but very clearly the weight is on this side of the equation. Well, thank you all very much for the time. It was great being here.
Okay, thank you so much for that. That was wonderful. We're going to have another quick, short little break while I flip the presentation decks. And then the last segment here is going to be on how to become the center of your client's estate at the estate planning side. So see you guys back in about 5 minutes. Check.